I just want to create a quick video helping you understand how you actually shop for a mortgage. So the first thing, which is where most people stop in terms of their search, is going to be, so this is going to be an important part, of course, right? And this is where most people mind goes. So this is the oh duh, but is the interest rate. So most people shop by going like this. They call a mortgage broker, they call a bank, and they call a credit union. And they say, what is your mortgage rate? Now, you're gonna be responded with, well, tell me about your property. Is it a single family home? Is it a condo? How's your credit score? How's your income, et cetera, et cetera. So we're gonna have that list of questions, and that's gonna determine the interest rates that is responded to you. And so someone would think, okay, I get, 5.5% here, 6% here, 6.5% here. Great, I'm gonna go with 5.5%. But it's what's behind this, right? So this is just the starting point, okay? So we understand the rate. The next thing that we need to understand is this. What is the cost or credit associated with that interest rate? So for our example here, so let's say we can obtain 5.5% by paying 2 points. A point is equivalent to 1% of the loan amount. So we have a $500,000 loan and we're paying 2 points. That's going to be $10,000 in points to obtain a 5.5% interest rate. Now this amount could be paid out of pocket or it could be added to the loan balance. So you do have a couple different options there. And then if we look at 5.75%, it's a little higher in rate, then it's going to be 1 point, or in our example, $5,000. Then if we look at 6%, it will be no points. Okay, so there's going to be no cost associated with obtaining a 6% rate. Now on the other end of that, what we have is if we went with 6.25%, you would be receiving 1 point of credit, meaning that $5,000 in a $500,000 loan amount, $5,000 would be given to you as credit for your closing cost, okay? And then if we went with 6.5%, we would get 2% of credit. So what's the rhyme or reasoning here? Why would anyone want to go with a 6.5% rate, even if they got two points? And why would anyone want to pay $10,000 just for a low rate? Well, the math works like this. If you plan on having a loan for a very short period of time, so let's say you're refinancing and you're planning on moving to a different home within a 2 to 3 year period. Well, oftentimes it can make sense to take that higher interest rate because the amount you're getting in credit is going to exceed the savings of interest over such a short period of time. Now, conversely, if we have a loan that we say, okay, I'm planning on living in this home for the next 10 years at least. I also don't see interest rates falling to a point where I would refinance again and that would make sense for me. And so it's worth it to pay 2 points, either out of pocket or added to the loan amount, because that lower interest rate over a period of typically 4, 5, 6 years, that break-even point starts where if you look at the total picture, you've saved quite a bit of interest over a longer period of time by paying the points and going with the higher rate. So now when it comes time to shopping for a mortgage, you can see that just saying, what's the interest rate, can be the wrong question. Now, it's a good starting point, right? Let's understand what the rate is, but the follow-up question has to be, well, okay, what is the cost or credit associated with the rate you're giving me? Now, there's going to be one other factor. So those are our two questions. What's the rate? What's the cost or credit? And what are the origination fees? Now, this can be disguised or categorized as different things, such as origination fee, broker fee, underwriting fee, processing fee, administrative fee. There's a lot of different names, but we want to understand what are all the origination fees associated with this. So now we can really do a very accurate job comparing by understanding what's the interest rate, what's the cost or credit associated with that rate, and what are the origination fees for the lender that you're talking to. So with those three things, you're going to be able to really shop and understand where to get the best loan for your scenario.